All right, welcome back to Talk Tickers. Today, we're tearing into Lucid's Q3 earnings, and boy, it's a real head-scratcher. On one hand, you've got record deliveries and this grand vision for the future. On the other hand, they are just torching cash like you wouldn't believe. So, the big question is, what's the real story here? Let's get into it. And that's really the heart of it, isn't it? Growth at what cost? I mean, it's fantastic they're putting more cars on the road, but is it sustainable? Or are they just digging themselves into a deeper and deeper financial hole? The numbers, well, they paint a very, very interesting picture. Okay, let's kick things off with revenue. They brought in $336.6 million. Now, don't get me wrong, that's up a whopping 68% from last year, which is huge. And there's always a but, it actually missed what Wall Street was expecting by about 4%. So even with that big jump, the experts were looking for a little more. And if you thought the revenue miss was something, take a look at the bottom line. The adjusted loss per share was a tough $2.65. That's not just a miss, it's about 17% worse than analysts were predicting. So think about that. They're selling more cars than ever, but they're also losing way more money per share than anyone was comfortable with. But honestly, this is the number that made everyone's jaw drop. A free cash flow burn of $955 million. I mean, let that sink in. We're talking about almost $1 billion incinerated in just one quarter. It's just a brutal reminder of how incredibly expensive it is to try and build an EV company from scratch these days. So this all brings us to the central theme here. It's a story of progress versus financial fragility. It really is a tale of two Lucids, right? You've got this amazing operational momentum, but it's built on a pretty shaky financial foundation. Let's really look at this contrast. And here's that split personality in black and white. In one corner, the operational wins. Record deliveries, up 47% year over year. That's their 7th straight quarter of record volume. That's some serious momentum. But in the other corner, you've got the financial headwinds. These just awful negative margins, that massive cash burn we just talked about, and a loss that was way wider than expected. So yeah, they're selling more cars, but they are absolutely not making money on them yet. And even with those record deliveries, it's not all smooth sailing. There are some real execution challenges here. Management actually had to trim their full-year production guidance. So they were shooting for 18 to 20,000 vehicles. Now they're saying it'll be around 18,000. And the reasons, you guessed it, the usual suspects. Chip shortages and, get this, a fire at one of their suppliers' plants. You just can't make this stuff up. Okay, so you might be asking yourself, how on earth do you justify burning through that much cash? Well, management's answer is simple. They're not playing for today. They're betting big on the future. We're talking huge, long-term plays on tech and, robotaxis. Let's look at their game plan. So, this is the roadmap they're selling to investors. Step 1, and this is the most important one, get the cash. And they did, by tapping into Saudi Arabia's PIF for a credit line that gives them a runway into 2027. Phew! Next up, scale the Gravity SUV. That's their big next product. Then, develop a more affordable midsize car. But here's where it gets really ambitious. They're planning to deploy over 20,000 robotaxis with Uber-Nuro. And the grand finale, partner with NVIDIA to be the first to market with level 4 autonomy. No big deal, right? And the interim CEO, Mark Winterhoff, he didn't mince words. He said, "We are playing to win." I mean, that quote says it all. This isn't about just surviving or being another EV company. They're making a calculated bet to try and jump over everyone else and become the leader in self-driving tech. It's bold. You have to give them that. So, you've got missed earnings, a guidance cut, but this incredibly ambitious vision. What did Wall Street make of all this? Well, to put it mildly, it was a wild ride. This is what we call the pop and fade. It's fascinating. Right after the earnings call, the stock jumps up more than 4%. Why? Because the market loved the news about the PIF funding. It meant they weren't going bankrupt tomorrow. But then, reality set in. Over the next week, all that optimism just evaporated, and the stock fell right back down, ending up even lower than before the call. The sugar rush wore off, and the hangover from the financial numbers kicked in. So, why did the enthusiasm fizzle out so fast? Well, it boils down to a few big concerns. First, that execution risk. Cutting guidance is never a good look. Second, dilution. A few days later, they announced they're raising another $875 million, which means potentially more shares and less value for current owners. Third, Let's be honest, the stock has been a real laggard, down 26% while the rest of the EV sector is up. And finally, the big one. No one can really see when or if they'll ever stop burning cash and actually make a profit. All right, let's wrap this up by looking ahead. It's time for our final segment, the next call. What should we be looking for in Q4, and what's our verdict on the stock right now? Okay, for the fourth quarter, here's what's on our watch list. We're expecting a big push in production to hit that 18,000 vehicle target. And for the first time, the Gravity SUVs should actually make up most of that volume, which is a huge milestone. But forget everything else for a second. The one number, the key metric you have to watch, is free cash flow. Can they finally slow down the burn rate, even while they're spending a ton to scale up? That's the billion-dollar question. So after weighing everything, our rating on Lucid is market perform. Look, the long-term potential here is absolutely huge. You can't ignore the PIF backing and their incredible tech ambitions. But, and it's a massive but, the short-term risks are just as huge. That cash burn, the execution, it's a massive gamble. The vision is incredible, but the financial reality right now is just brutal. And as always, just a quick reminder that this is not financial advice. Everything we've discussed today for informational purposes only.